There's a handful of retirement accounts most people have at least heard of, and there's a good chance at least one account in this video is completely new to you. By the end of this video, you'll know exactly what each one does and which ones you should actually be using. Retirement accounts get a bad reputation for being confusing. Honestly, most of that confusion is unnecessary. Once you understand the basic idea behind them, every version out there is just a small tweak on the same theme. So today we're doing a full breakdown: what each account is, how the tax benefits actually work, and which order to prioritize them in. Stick around to the end, because the order matters more than most people realize. The one idea that makes all of this make sense. Before we get into individual accounts, you need to understand one thing. A retirement account is not an investment, it's a container. Think of it like a cup. The cup doesn't matter. What matters is what you pour into it. Stocks, bonds, index funds, ETFs. That's the actual investment. The account just determines how that investment gets taxed. Once that clicks, everything else in this video will make a lot more sense. So let's start filling in the containers, starting with the one most people run into first: the employer-sponsored retirement account. This one usually shows up the moment you get your first real job. Contributions come straight out of your paycheck before you ever see the money. The single best feature of an employer-sponsored retirement account is employer matching. If your company offers to match your contributions up to a certain percentage, say 6%, and you contribute that 6%, they add their own 6% on top. Put in $300, get another $300 added by your employer. That's a 100% return before your money has even had a chance to grow. If your employer offers a match and you're not contributing enough to get it, you're turning down free money. For 2026, you can contribute up to $24,500 to an employer-sponsored retirement account. If you're 50 or older, you get an $8,000 catch-up contribution, and if you're between 60 and 63, that catch-up jumps to $11,250. Now, before we move on to the next account, there's a decision that comes up inside this one, and it's going to come up again and again for the rest of the video, so let's settle it now. Traditional versus Roth. This applies to almost every account. Here's a concept that shows up again and again: traditional versus Roth. Traditional accounts let you contribute pre-tax money, lowering your taxable income today. You pay taxes later when you withdraw the money in retirement. Roth accounts work in reverse. You contribute after-tax money now, but the account grows completely tax-free, and qualified withdrawals in retirement owe nothing, not even on the growth. Generally speaking, if you expect to be in a lower tax bracket now than you will be later in your career, Roth tends to be the more efficient choice. If you're already in a high tax bracket and expect it to drop in retirement, traditional can make more sense. Most employer-sponsored retirement accounts and IRAs offer both options, so keep this traditional versus Roth decision in mind. It's about to come up again with the next account, the IRA, which brings us to account number 2, an IRA, individual retirement account, is different from an employer-sponsored retirement account in one key way. You don't need an employer to have one. You open it yourself directly through a brokerage. Like the employer-sponsored retirement account, it comes in traditional and Roth versions. A traditional IRA may lower your taxable income today, depending on your circumstances, and grows tax-deferred until withdrawal. A Roth IRA is funded with after-tax money and grows completely tax-free, including decades of investment gains, which come out untouched by the IRS in a qualified withdrawal. For 2026, the IRA contribution limit is $7,500 combined across traditional and Roth, plus a $1,100 catch-up if you're 50 or older. One important detail: Roth IRAs have income limits. If you earn above a certain threshold, your ability to contribute directly starts to phase out. Though a workaround called the backdoor Roth exists for higher earners. That covers the two accounts everybody's heard of. Now here's the one most people haven't touched, and it might be the most underrated account on this entire list: the HSA, the health savings account. If you're enrolled in a high deductible health plan, you're eligible, and it offers something no other account does: a triple tax advantage. You get a deduction on contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Here's a strategy worth knowing: pay for medical expenses out of pocket now, keep the receipts, and let the HSA balance invest and grow untouched. Years, even decades. Later, you can reimburse yourself tax-free for that original expense, effectively turning the HSA into an additional retirement account. For 2026, you can contribute up to $4,400 for individual coverage, or $8,750 for family coverage, plus an extra $1,000 if you're 55 or older. That's 3 accounts down, all of them built specifically for retirement, with real tax rules and real limits. The fourth one breaks that mold entirely: the taxable brokerage account. This one isn't a retirement account in the technical sense. There's no special tax treatment going in and no upfront deduction. but it deserves a real look because of what it offers instead: no contribution limits and no restrictions on when you can withdraw. Here's how the taxes actually work. You don't owe anything just for holding investments in a brokerage account. Taxes come into play in two situations. First, if the investments pay dividends, you owe tax on those dividends the year you receive them, even if you reinvest them automatically. Second, when you actually sell an investment for a profit, you owe capital gains tax on that profit. And there's a distinction that matters a lot here. If you held the investment for over a year, it qualifies for long-term capital gains rates, which are lower than ordinary income tax rates, often 0%, 15%, or 20%, depending on your income. Sell before that 1 year mark, though, and it's taxed as a short-term gain at your regular income tax rate instead, which is a good reason to avoid frequent short-term trading in this kind of account. The trade-off for all this flexibility is simple. You don't get a tax break going in the way you do with the accounts above. That's exactly why it's last on this list. A taxable brokerage account is what you use once the accounts that reduce your taxes today or in retirement are already taken care of. So that's all 4 accounts. But naming the containers is only half the picture. Let's go back to that idea from the beginning of the video for a second. What should actually go inside these accounts? The account is just the container. What you put inside it matters just as much. For most long-term investors, low-cost index funds or ETFs that track the broader market are the standard recommendation. Instead of trying to pick individual winning stocks, you own a small slice of hundreds of thousands of companies at once. It's a simple approach, and historically, it's also one of the most effective ones over long time horizons. One last thing before we wrap up, and it applies to almost everything we just covered. One rule that applies to nearly every account on this list. Almost all of these accounts are designed for retirement, and the tax rules reflect that. Withdraw funds from most of these accounts before age 59 and a half, and you'll typically owe a 10% early withdrawal penalty in addition to any taxes owed. There are limited exceptions. For example, using Roth IRA contributions toward a first-time home purchase. But the general rule is to treat this money as inaccessible until retirement. All right, that's everything. Let's bring it all together. Quick recap. Employer-sponsored retirement account, offered through your job. The employer matches free money, so this is where your first dollar should go. IRA, you open this one yourself. No employer needed. Same traditional versus Roth choice as above, just with a smaller contribution limit. HSA, the one almost nobody talks about. Triple tax advantage, and it doubles as a stealth retirement account if you let it grow instead of spending it. Taxable brokerage account. No tax perks going in, but no limits and no restrictions either. This is where extra money goes once everything else is maxed out. And if you remember nothing else, remember the order. Employer match first, Roth IRA second, employer-sponsored account third, HSA fourth, brokerage account last. If you found this useful, hit the subscribe button, and let me know in the comments which of these accounts you're already using and which one you're going to open next. Thanks for watching. I'll see you in the next one.